There is no easy way out. It doesn't mean the end of the dollar or the end of America or the end of the world. It just means we're going to head into periods of austerity, market mean reversion, poor currency behavior, volatility, political centralization, most likely. That's what happens in this cycle from debt to social unrest to centralization, the symptoms of which are many places. I just don't think there's a way to avoid that. And it's not being cynical or pessimistic. It's just to have preparation. There are great opportunities in such crises too. Don't get me wrong.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest expert has long warned about the dangers of too much debt in the global economy. The ever-growing mountain of it enables nations to spend beyond their means, creating asset price bubbles and wealth inequality in the present, but destroying the purchasing power of their fiat currencies in the long run. So, where are we today on the timeline of debt-driven monetary decline? And how are precious metals, the historic defense against such currency debasement, faring this year in protecting those savvy enough to own them? For answers, we welcome back to the program Matthew Piepenburg, partner at VonGreyerz Gold. Matt, thanks so much for joining us today, all the way from Europe.
All the way from Europe. It's great to be back, Adam. Looking forward to it. Absolutely.
Thanks. Well, it's been too long, so I'm very glad that we were able to make this happen. You look great, by the way, my friend. All right, well, look, lots to get into, and obviously it's been a big year for the precious metals, so I'm sure we have a lot to talk about there. But, I haven't done this in a while on this program, Matt, but because you take such a high level view of the whole economic financial system, and it's been so long since you've been in the program, I am going to revert back to my old standard opening question. What's your current assessment of the global economy and financial markets?
Well, it's very negative, as you can imagine, and it's nothing new. The facts haven't changed, they've gotten worse, and some of my opinions have just become more entrenched. I think, again, it's a moment of debt karma that is not at all theoretical. It is literally happening in real time. It's been happening, frankly, for years. We're at a revolutionary moment where the hangover for drinking the fantasy that we could monetize debt by debasing currencies with and really run deficits without tears, as David Stockman said. I think that jig is up. And we've many times we've spoken, but I think one of our first interviews, you said you were quoting a film title called No Way Out. And I think we're at that no way out moment where it's becoming quite obvious that the bond market, and it sounds boring, but because we're in a debt cycle, in a credit cycle that's nearing an end, the bond market has more power than the bravado of a politician, left or right. The bond market told Powell, for example, that he couldn't win the war on inflation by higher for longer because the rate hikes were too painful for our debt levels. And the bond market just told Trump on Liberation Day that he couldn't speak loudly and carry a big stick and dictate trade policy globally because the bond market wouldn't allow him. So, like Powell, Trump had to pivot, regardless of their motives, good or bad, smart or genius, stupid or not. We're at a point where we don't have the power we might have had in 1944 or 1971 as a nation. But globally, again, Adam, it was just 1997, global debt was about 30 trillion. Today it's 300 trillion. And if you look at the chart, it's absolutely fantastic. It just goes straight up into the right after 97. You cannot run those kind of debts without the P in GDP, without the income commensurate with the spending. And because we have done that as a nation, and because the world has done that in general, we are in a debt crisis. And the US, as the home of the world reserve currency and the 10-year US Treasury, is in a particular crisis. And that crisis has ripple effects. And I'll stop in 2 minutes, but I just want to be very clear. It sounds, as I've said many times, very reductionist, very first derivative, just to say everything's about debt. I was talking to John Rubino not too long ago, and he sent me something recently. A difference between a billion and a trillion is kind of theoretical, just a B versus a T. Maybe sounds just academic, but I think a billion seconds ago was like 1997 or something, or 1993. But a trillion seconds ago was 30,000 BC. So I mean, right. This is extraordinary. These numbers are not just things we throw out there. It's hard to conceptualize the level of debt we're in, and the second and third derivative impacts that debt has on geopolitics, on stocks and bonds, on precious metals, on currencies, on social unrest. Whatever thread we want to pull on today, Adam, they're all tied to the fact that we have lived beyond our means and fantasized and and had too many martinis without that hangover, that constructive destruction that Schumpeter of the Austrian school and von Mises and David Hume and Hemingway warned of. And we're in it now. And again, we're seeing that we don't have the biceps that we thought we had geopolitically or financially, just in our inflation fight and in our tariff policies, and also in the social unrest, which is everywhere, not just in the US. And as an American living now many years overseas, I can tell you, it's not just the US that's going from this massive shift towards this globalism, which was a pejorative thing, towards the more nationalism, protectionism, or you could call it mercantilism. That this is real. It's not theoretical. There's a shift. And I've said many times, we're at that Gettysburg moment or that Waterloo moment or that Stalingrad moment where we are changing, but things don't like to change and accept that they're changing. They keep fighting on. They resist the change. It's a revolutionary moment in our global financial and geopolitical history right now. And the powers that be, whatever you think of their ideology, have failed. And the powers to come, whatever you think of their ideology, are going to come. You could be optimistic, but in every revolution, I'm sorry, you don't have revolutionary change overnight, and you never have it without a mess. And we're heading into the messy stages right now. It's obvious to me, whatever thread I pull on, again, socially, financially, politically, currency, even in our hopes and dreams, there's a definite turning point now that is palpable. And again, you can say it's the Trump effect. That's too simple, or it's the tariffs. That's too simple. Why did Milei come in power recently in Argentina? Why did Meloni come in power in Italy? Why did Moloki just get elected in Poland, or Orban in Hungary, or Nigel Farage now is a new power that's replacing the Tories and Labour, which were sacrosanct for years? Why is Marine Le Pen being lawfared out of office? And why is the AfD party in Germany not being taken seriously? Why are the people, whatever you think of the politics, left or right, why is the voice of the people ignored, and Band-Aid coalitions from the Trudeau, Fauci, Biden era to today being still resisting this change? And I'm not saying the change is all good. I'm not saying that the Trump effect or this new pendulum swing towards a more protectionist nation-first mentality, towards a more anti-immigrant or anti-left policy. I'm not saying that's good or bad. I'm saying it's clearly happening. And there's a change in our cooperative spirit and our trading spirit. All of these things are happening so fast because all of these countries, and the US included, are in a desperate corner. And countries in desperate corners do desperate things. And they elect desperate ideas and desperate fantasies, left or right. I'm not making a partisan stance here. And I can understand all the criticisms of Trump and all the criticisms of Biden or Trudeau or the AfD in Germany versus Merz. It's past that now. We're past that, because it doesn't matter, as I've said many times, to the no way out thesis that you and I talked about years back. There are no good scenarios left, whether we cooperate or not, whether we elect Santa Claus or the Wizard of Oz or a room full of Nobel laureates. We are not going to solve all of the myriad ripple effects of this trillion abstract type of debt levels, multi-trillion debt levels, in one term, in one ideology, or in one midterm, or under one particular leader. And there is no easy way out. It doesn't mean the end of the dollar or the end of America or the end of the world. It just means we're going to head into periods of austerity, market mean reversion, poor currency behavior, volatility, political centralization, most likely. That's what happens in this cycle from debt to social unrest to centralization, the symptoms of which are in many places. I just don't think there's a way to avoid that. And it's not being cynical or pessimistic. It's just to have preparation. There are great opportunities in such crises too, don't get me wrong. And there are great opportunities to have more cooperation, better government, better ideologies, even better policies. But whoever is in the White House or at the IMF or at the BIS or the ECB or in power in Germany or Argentina, it doesn't matter to me so much right now, because none of us can fight the tide of debt and the ramifications of it without some austerity, without some candor, without some cooperation. Long answer to a short question, but we are in a revolutionary moment. We're living it. It's very hard to see when you're in it. You're used to reading about it in the past tense, so it's hard to be objective. But as I've said all the years we've spoken, there's no getting out of this. There's no way out. It doesn't mean the end, but there's no clean, easy way out in this transition period. It will be messy. It already is messy. and it's going to get more messy, in my view. Again, very cynical, but that's how I see it.
Okay, well, cynical but consistent with the logic that you have been, laying out for the years in which you and I have known each other, Matt. So let me ask you this. So clear that you see we're at some sort of flashpoint or inflection point where the action starts to really pick up speed here. And I'm reminded of the old Hemingway quote, had to go broke slowly and then all at once, right? Um, and it sounds like you think we're getting closer to the all at once stage here because the debt mountain of all these trillions is now getting harder and harder to service. Um, Let me ask you this though. I totally get in one man's opinion. I sort of share your view that barring some sort of miracle that I can't see happening, there is no way out of the debt equation here, right? It's so big and it's continuing to grow that it seems hard that we're going to find a permanent way out. So I agree, no way out, right? Now it won't be a straight line. Maybe in the arc of history, it will sort of accelerate as we slide down here. But things tend to not go in a straight line in directions, and you have sort of cycles where things get worse, and they get better, and they get worse, and they get better. And I'm just wondering if in the wave of protectionist national parties, you just listed a whole bunch. I've given similar lists recently on this program. We are seeing this ripple effect of countries saying, hey, we got to start doing things differently. And here in the US, very early to make any sort of long-term calls, but fiscal responsibility is suddenly kind of getting thrust back into the limelight. We had Doge. We have a lot of debates right now with Trump's big, beautiful bill. Folks are beginning to wake up. Hey, just like all past bills, this adds a lot to the debt in the short term, increases deficits, et cetera. And maybe we'll go back to business as usual. But I guess the question I'm trying to ask here is are you at a stage where you're like, look, this thing is just careening down at an ever accelerating pace, and we all got to kind of assume the crash position? Or is there potential here that, well, we may, given this sort of this sweeping change of reform that seems to be going on right now, maybe different attitudes could buy us a little bit of time here. We're still not going to get out of this without a lot of pain. But if countries slow their deficit spending, which nobody is yet at this point, but if that becomes more in vogue, is there potential here to kind of pump the brakes a little bit before things reaccelerate?
Well, my short answer is no. Again, very cynical, very direct. And I want to try and take this past the offense or defense or upsetting. Let's take any view you have, left or right. I'm saying you, the audience, me, us, any of us. Let's try for a second to remove the polarized partisan lens that we look at everything through. And again, I can think of 1,000 reasons to criticize Trump or Biden. We can go that, it's just a rabbit hole. But let's just look at the optics of what we've seen, because this is the president we have, and this is the policies we have. There is clearly a checklist of things that optically look good, whatever your parties, whatever your politics for the country, you could argue. There's nothing wrong with trying to cut spending, but we can fight about what spending to cut, and that creates, then the biases come back in. But programs like Doge, to cut 2 trillion in the next 2 years, I think that's refreshing to even hear a guy like Scott Bessent talk about a debt crisis or instruct Trump what that means and teach him what that means so he understands that. There's nothing wrong with the optics of 2 trillion spending cuts if we even get to that. We're not close to it yet, but regardless, you can't argue that's a bad thing to try and cut spending. We actually have to. There's nothing wrong with cutting corruption in US aid, but then you can fight about, well, is that cutting corruption? Are we killing children in South Africa or Africa because we're not doing that? There's nothing wrong with trying to lower taxes if you want to think about that in big, beautiful bill, but there's all kinds of debate about that. We can't deny, though, that there is a huge change in activity. Love or hate Trump, it's a lot more activity than what was going on in the last administration. And there's no denying left or right. It should be an American issue to me that our president in the last 4 years was not sharp as a tack. It just, regardless of politics, there was objective evidence of that long before the debates. This is not me attacking the Democrats or the left. That's an American problem when our cabinet, when our press secretary, when our media, when our Congress tells us something that our own eyes know is not true, that our own ears know is not true. So whatever we did in the last 4 years, we're seeing more activity now. You can debate it. Immigration is clearly activity in the immigration. It's causing social polarization, political polarization, tax cuts, deregulation, Doge, immigration policies, USA, cutting spending, even tariffs, reshoring jobs. You can argue about that, and we could argue both sides of that all day long. There is nothing wrong with the ideal of reshoring jobs back to America. The Rust Belt, right, came from the Midwest, where millions of jobs were lost. So you can argue that you can say the intentions are good and the policies are active, and there's more activity now than then. But again, I'll say that all those things are checking a lot of great boxes for doing something active. And I'm not trying to be critical just because it's Trump in the White House. It could be anyone. Again, it could be the Wizard of Oz. To me, mathematically, those numbers and those policies are guppy solutions to a whale of $1 trillion problem. And again, this goes to hard math. When you have a debt to GDP of over 120%, we learned this in the 18th century, growth slows by a third. When you're at the trillions where we're at now, we're running a debt to GDP that we had during the Second World War, when you could understand that kind of spending. You could understand that was, if there was ever a good war, probably a good one. And there was a need for that kind of deficits and debt. But what's the emergency today in 2025? What's the fascist threat? What's the Third Reich that we're expressing this through? What is the problem? The problem is decades and decades of politicians buying votes and time and theoretical growth, which is debt-based growth, on a debased dollar, unchaperoned by gold, and created with a 5x expansion in 20 years. We're getting all this growth, we're getting all this inflation in the risk assets, we're getting all this vote buying by running massive deficits and debt levels, which we then monetize again with money moused up to the central bank. That is a fantasy. And that creates the temporary prosperity that Hemingway talked about, that drunken pleasure that we all felt at a frat party in college, or when our parents aren't home, when we're teenagers, when the chaperone's gone. But we cannot avoid the hangover of decades of that policy mathematically. And we're at that point now. And sad thing is, even if we give $1,000 every new baby born in America, that's the latest headline, fine. Even if you monetize the S&P so it never sees a dip more than 30%, you can technically do that mathematically, but there is always a cost, because if it sounds too good to be true, it is. So you can do that at the expense of your currency. That hurts millionaires and billionaires. That really hurts the middle class. That hurts the man and woman on the street, because your only way you can buy that type of prosperity, it's the permanent ruin, Hemingway called, of inflation and war. And that's where we're at right now. It's not me making this up. And that inflation isn't just a term of art used by economists or academics or intellectuals. That is the money in your wallet, in your checking account, in your 401k, in your portfolio at a hedge fund. So you're measuring your money in a beautiful ice cube. It's melting quantifiably and objectively by the day. And I think a lot of people, through no fault of their own, don't think of that part of it. They still measure their wealth in dollars, which on a relative basis is better than certain other currencies for sure. But they're not seeing the invisible tax of the debasement of their currency. America was founded on no taxation without representation. We're getting taxed without representation. We just don't see it. It's literally eating away at our purchasing power. And that debt, again, everything starts with debt, is second derivative. That's why we have social unrest. When 20% of Americans, their only salary goes to pay rent, not even a mortgage, rent. They take a second job to pay for food. When 10% of the top 10% of America owns 90% of the stock market wealth. And again, I've said there's a massive, and I see it in Europe, I see the wealthy Americans coming to Antibes, Paris, Florence, Barcelona. I see them at the polo fields. I see them in the city streets of all these beautiful cities. They come in, many of them on private jets or first class tickets, because that wealth inequality from the policies we've created is so palpable. They're so removed culturally and socially from the rest of America. That's created a major problem. And what does Bissett keep saying? This administration is about Main Street, not Wall Street. What does Trump represent? How did he get elected? The populism of at least recognizing the middle class, trying to reshore these jobs. So again, optics are great. I'll stop there. The reality is it's already there. It's already happened. And in this ideological shift from globalism to protectionism, it doesn't change the fact that you're not going to fix this in one term or one decade. That we have to be honest, as we would in a family or in a boardroom, that we're broke, that we're over our skis in debt. We have to cut spending. We have to expand our growth. That's going to take decades, not one term or one rare earth deal in Saudi Arabia or one trade concession. And again, that's no fun at a cocktail party. But I've been saying this for years. You guys have been saying it for decades. And many people, Reinhardt and Rogup, have been saying this. And I'm not saying this to be a gold bug. Warren Buffett is telling you this. You know, Ray Dalio, biggest hedge fund manager in the world, is saying this. Jeremy Grantham at GMO is saying this. Gunlach, the bond king, is saying this. So this is not gold bug cynicism, pessimism to get you to scare you into gold. All this debt, all this currency destruction, all this inflation, all these geopolitical risks, all these changes are real, and they're affecting us, and they are creating the social unrest that I've always talked about that follows inflation. And what follows social unrest is more centralization, more dishonesty from a country who gets its media from 5 media sources, where in the 80s we had 50. So a lot of people who are trying to be critical thinking about this, get past the gold bug, get past left versus right, look at the purchasing power of your $100, your $10, your $20, whatever your salary is per hour. It's getting weaker. You're getting suckered to buy time. And we're running out of time because now everyone feels it. I mean, everyone feels it. Who's paying tuition, who's paying a mortgage, who's paying insurance. It's no longer theoretical gloom and doom. It's right in front of us. And the solution, I feel, is many years off, and it's going to require a heck of a lot more cooperation. We need to be sending out olive branches, not sticks. More carrots, less olive branches. In a world that's going that way right now.
Okay. So very well said. And I've said many times on this program, when asked, about my own thoughts on where things are headed, I talk to smart people all the time, often who can look at the same data and come up with different conclusions, and I can find all of them very persuasive. But the one issue that I think I have the greatest confidence in is the continued devaluation of the purchasing power of fiat currencies. You've just made, great arguments for why that's going to happen. So I take from you, Matt, that you don't really see much, if any, opportunity for us to, eventually by better behavior, get the plane out of the descent and miss the crash and get back up to cruising altitude. Sounds like you think, hey, we better assume the crash position. This is one of those things where the current system is going to break, and we're only going to get something better out of the wreckage and ruin, where we look at what happened and said, wow, that wasn't good. We should probably do something better off going forward, but probably not going to avoid that kind of calamitous break. You're nodding as I'm saying all this. So I want to move on real quickly in just a second about, okay, so what should we do about it? And obviously I know from your point of view, precious metals are a part of that solution. That's a big reason why you've dedicated your career to this. Let me just ask you this one thing. So you talked about kind of the difference between $1 billion and $1 trillion, right? And in a previous company, we tried to help people understand just sort of how big $1 trillion was. And I think the honest thing I took from it is that it's so big that humans just really can't. We can kind of generally understand it, but we can't truly conceive of it. And the mnemonic we used to use, not the seconds, which is a very convincing one, but is take $1,000 bills, right? And if you had a stack of $1,000 bills, one on top of the other, if that stack, I'm doing this from memory, so it might be a little bit off, but if that stack's like 4 inches tall, that's $1 million, right? So $1,000, it's not nothing, right? You wouldn't throw that bill away. You wouldn't pass it by in the street, right? You get a stack 4 inches, that's $1 million, right? A stack worth $1 billion is a couple 100 feet tall. Basically, it's about as tall as the Statue of Liberty, right? A stack $1 trillion tall is 67 miles up into space. I mean, it's just crazy. It's so much bigger than we can think. And so, we're now at the stage where we spend trillions annually as a country. We run a deficit in the multi-trillions. When something goes wrong, we immediately turn to stimulus now that's in the multi-trillions. And my question for you is, did we sort of seal our fate years ago when Congress sort of made the jump from billions to trillions and just, we have a bunch of politicians, many of whom don't have much of an economic education, if at all. And to them, it's just a bigger number, right? But they're playing with fire. They're playing with orders of magnitude that just nobody understands. And when it comes time to actually service those trillions of debt that you're taking on sort of cavalierly, like, yeah, we'll just pass that this year because we just have to, right? You're sort of condemning, the nation of the future to this calamity that you're expecting because the math is just so overwhelming.
Well, it is, and again, it's fascinating. And again, it's not gold bug negativity. Anyone should understand the lack of far-sighted thinking. You can go back to 1970. What's the patient zero of this type of stupidity? How did we get this way? And I said we took the chaperone away from the dollar under Nixon when we decoupled from gold. That was one part of the thing, but that in and of itself wasn't enough to destroy the dollar longer term or the next generation at the expense of this one for such myopic thinking. But certainly going off the gold standard was kind of chapter one. And it wasn't even like Nixon or even other European central banks or the Fed suddenly just started going hog wild. It took some time to actually realize the power we had of an unchaperoned currency, that we really could go into more and more debt. And then without a gold, a gold ratio that we had to keep, we could actually create and broaden the money supply more and more. So there was that opportunity that we didn't necessarily take advantage of right away. It kind of came into the 80s when Stockman was there with Reagan. He started to notice this was a problem, the bond market of the 90s. But by the great financial crisis, Bernanke came in and he spent $2 trillion in printed money in 4 years. But then when we had the COVID crisis, Powell did $5 trillion in 18 months. So suddenly it became much more addictive than just an emergency measure. And I want to go back to even Bernanke under the great financial crisis. We bailed out the big banks for $780 billion. That almost seems like an innocent number now, $780 billion. It seemed insane when you and I were in the streets, so to speak, working West Coast and East Coast during that period. $780 billion to bail out the banks and AIG and Goldman and all. That's crazy. That's almost sweet numbers compared to the trillions we've gone since then. And remember, when we got off the gold standard, Nixon promised that it would be temporary. That was how many years ago? 55 years ago? That was going to be 54 years. That was temporary my entire life. We've never gone back. It was not supposed to affect the dollar. And when Bernanke started printing money, it was supposed to just be QE. Then it became QE1, QE2, QE3, Operation Twist, unlimited QE after the COVID hysteria. So again, it starts slowly, then all at once. The desperation, the addiction, the magical fantasy that this policy is actually a policy as opposed to a charade, a scam. And now the karmic results of that is we're running out of leverage as a superpower, as a hegemonic form of the world reserve currency. And we're running out of options to play with rates to solve the problem because we can't afford higher rates because of those trillions, those miles of debt stacked up. That the rest of the world sees, if you and I see it, the rest of the world sees it too. They are not buying our treasuries. When we did Liberation Day, the treasury auction the next day, there was no one there. It was crickets. No one wants Uncle Sam's IOUs because we have too many stacks of debt. And we weaponized that same IOU in 2022. Whatever you think of the Russian-Ukraine war, we've lost trust and credibility because of debt and bad policies. And so the only way to solve the delta between our debt and our spending, we had deficits of $500 billion in 2008. It was then annual about $1 trillion after COVID. Now we're looking at $2 trillion spending versus income every year in America. It's getting worse, not better. I'm not making this up. These are just hard facts with trillions of dollars behind it. I'm sorry, Adam, I can't hear your sound. I think you're hit.
Sorry, that was my bad. I'd put myself on mute and didn't realize I had not taken myself off of it. Cut mute. All right, 3, 2, 1. Let me just interject for 1 second here, Matt, too, because I don't want people to take away from your comments that because of certain things America's done, people are less interested in owning its debt. That's true, but it's not like there's other countries out there that are super preferable debt-wise to America, right? I mean, they're making all the same mistakes. And so I think the big issue, and this will be our segue into talking about precious metals, is the world is starting to wake up to this issue, this debt trap, right? And they're saying, well, look, I don't know how much more of this other debt from any country that I want to own. So where do I actually hold my treasury, right? And we're starting to see, especially on the sovereign side, countries saying, well, I guess I'm going to start buying some more gold, right? And so that's definitely been a big driver over the past several years of the increase that we've seen in the precious metals complex. We've also seen that joined by the Eastern investor / speculator. Less so in the West until-ish, maybe starting around now. You obviously know more about this than I, so let's make the full segue here. From your professional vantage point, What's the current state of the precious metal sector right now here in 2025?
I think it's obviously making the headlines for a reason. A lot of that's driven by price movement, of course. These, 78, 80 record highs this year alone. It's the best performing asset in 2025. That's fantastic, but I never look at the price because I think we're still in just chapter one, chapter two. I want to start to your initial point. Let's be very clear. I don't think when I make fun of America, so to speak, or criticize American financial policies, I'm only doing that because it is the home of the world reserve currency, and it is the world reserve currency, and the sacred 10-year tier one, 10-year treasury is a tier one asset. But yes, to your point, and believe me, we could spend a long time talking about all the problems the EU has, and certainly China. So I'm not saying that America is alone in this. But to your point about gold and why it's making the headlines now and why we've foreseen this for years, it wasn't hard to see the exponential rise of gold, not because gold was doing anything more active, it's because the exponential rise again in debt meant an exponential debasement of the currency to monetize that debt so that your fiat money, that beautiful ice cube, was losing purchasing power. When we weaponized that 10-year FX reserve of a major nuclear power in 2022, the world, for two reasons, stopped trusting the American dollar or the 10-year IOU the way it used to in the past. A, it's a weaponized asset. You don't trust as much. If they can do that to Russia, they can do that to anyone. And B, it's overissued debt from a discredited, more and more indebted issuer. So there's a number of reasons, but if you saw what central banks were buying, I've said this many times, 118 tons prior to 2022, central bank purchases of gold went for 290 tons, almost 3 times X. And if you read the Gold We Trust report that just came out from Ronnie Sturfel and Mark Valek, the central bank purchasing of gold is not because they're chasing price action or because it's a better return than the S&P in the last 20 years, which it is. The reason they're stacking gold and the reason the BIS has made gold a tier one asset, and the reason the COMEX is seeing outflows, and the reason even the IMF talks about a new CBDC with gold coverage is because that tier one asset, physical gold, stores its value better than a US 10-year, the risk-free return, which again, when measured against real inflation, not the BLS's inflation, is return-free risk. It's just, there's just no return. You're not beating inflation. So the central banks see what you and I see. They'd rather save in something that holds its value better than a US Treasury or US dollar. They'd rather save in physical gold and then spend in fiat. And then they'd rather net settle their trades in the BRICS in something they trust, even though they don't trust each other. They trust that store of value in gold. And that's simply what's going on. And it's the symptoms of it are everywhere. It's not just the price action. It's the demand from, I'm not a big fan of central banks. I'm not a big fan of the IMF. I'm certainly not a big fan of the BIS. You can spend hours criticizing all of those things. But they're not stupid. And they see the direction of the hockey puck very clearly. And they've been seeing it for years. We've been seeing it for years. Our clients have been seeing it for years. Egon's been seeing it for 20. He bought gold at 300. It's at 3,000. He's not bragging about the price appreciation. He's just glad he didn't save in dollars. It's great to see the price move, but he knew that milligram of gold is going to hold its value better than a dollar, Canadian, Australian, US, or peso, or yuan, or French, or euro, or a Swiss franc. That wasn't because he was a genius or because he was a cynic. It's because he saw the history of debt and the history of currency debasement to monetize that debt. And that the one asset that the world goes to in times of crisis is gold because it holds its value. Bitcoin has used the store of value case, the same fear of debt, but gold holds its value better. And so it's just understanding that is understanding why gold is rising. It's not the sexy thing du jour. It's been outperforming the S&P for the last 20 years, total return. But family offices make less than a 1% allocation to physical gold. And there's a lot of reasons why. And it's the best performing asset this year, but it's been the best performing asset annualized for 20 years, and yet no one touches it. The smart guys, the family office guys, the former banks who are the CIOs of those family offices are not buying it. They're not touching it, and it's been clearly on the radar. But now, because of the headlines and the price action, it's suddenly discussed, but it's still woefully underallocated, which I find fascinating for a number of reasons. But it is remarkable the misunderstanding of this. And there is a vested reason to make gold misunderstood. For one thing, it's an embarrassment to any monetary policy where the dollar is losing value. Gold is a red neon flashing sign that you have been criminally negligent in your monetary policies. Your dollar is disrespected and distrusted. Gold proves that, so we don't want to talk about it. I still have very wealthy clients say their advisors at Goldman or wherever they are in Greenwich to Palm Beach, their advisors say gold is too volatile. Too volatile? For 20 years, it's outperformed the S&P. And just now they're being told it's too volatile. So again, is it ignorance? Is it conspiracy? It doesn't matter. It's a deliberate misunderstanding of a simple thing called sound money. It's not just about price appreciation. So again, the world is turning to gold because fiat money has been doing what it does throughout history, losing its value as debt becomes greater and greater and politicians become more and more desperate. And that shouldn't be a gold bug case. Again, hedge fund managers and risk assets that I've traded with and known for years understand this as well. Bankers even understand this. They just don't talk about it out loud. But they come to Zurich and they store their gold in our vaults for a reason because they know this. But they don't tell it to their clients because they can't if they work for a big bank. And they may be trading long short equities or arbitraging credits at a 2 and 20 hedge fund. But when they make their profits every year, they store a big chunk of it in the gold. I see it. I know this. It's not an apology for gold. I'm just trying to say the smart money is doing this. The family offices were run by kind of bankers, I hate to say it, aren't doing this. And the sad thing is the middle class who can't afford rent and groceries and a vacation, they're left out in the cold. And we keep saying to them, you can always afford a milligram or an ounce of gold, but you know what? That's not always true. And that's the real sad part. And that's not me trying to be falsely compassionate. It's really a problem because I am from that lower middle class background. I grew up there. The men and women in my town, they couldn't even imagine buying an ounce of gold at 30,000 plus. That's a luxury to them. And so not everyone can protect themselves, even those who can don't. But those who understand sound money and the history of it are doing it every day, every month, every week at our offices in Zurich. And it's just
well, and that's one of the questions I wanted to make sure to ask you here, which is, you are a partner at VonGreyerz Gold. It is one of the preeminent gold storage companies in the world, hands down. Very white glove treatment. You're kind of at the upper echelon of the industry there. So you are dealing with, clients that have a lot of money, and are either very aware of all these issues because they've worked hard to build their wealth and they're well educated and they're trying to protect it, or they're paying good advisors who are telling them, hey, you need to have some of your assets in this secure form factor. Are you seeing anything notably this year, past 6 months, past 12 months, in that crowd? In other words, is the smart money accelerating their buying? Are they buying less? Are they just not really that, no change, even despite gold's recent run up in price? What are you seeing in the industry amongst your clientele around this?
We're having a very busy year. And again, I'm not saying that just to say that. We're having a very busy year. And I remember even a year ago when gold was at 24, 26, there were some new clients calling saying, I think it's a little high, 26. And I understood that was peak gold at 26. And we understand that. No one likes to buy the top. And we said objectively in our humble opinion, we're not making this up. This is just chapter 2. This 36 or 46 is still not too cheap if you're buying gold for the right reasons. And that's the key if. If you're thinking 20, 30 years out, if you're thinking preservation and you're thinking legacy and you're thinking next generation, as Ronnie Surflet tried to argue, and as the American Indians taught their kids, the Native Americans, you think 3 generations out, not an election cycle or not a quarterly return. If you're thinking many years out, gold at 2,500, 2,600, 3,600, or 4,600 isn't the point because it will certainly hold its value far better than fiat money. And as the world becomes more and more leaning towards gold as some type of coverage to ensure fiat money or to back fiat money, it's only going to get higher, regardless of what Bitcoin does or doesn't do. It's irrelevant to me. And regardless of the price move, again, Egon at 300, was that too expensive when you could get it at $35 7 or 8 years before? No, it was never about the price. It was about the direction of fiat paper money, longer term. If you're a trader or you're looking to get the best trade of the year, yeah, gold was the best trade of the year. And you got to get out at the top. It doesn't go in a straight line. But if you're thinking decades, whether you bought it at 18 or 36, I know that sounds flippant, is not the right question, because it will hold its value better than anything else, better than fiat money for certain. And that's why we appeal to those type of investors in 90 countries who stay with us for decades, not for a term, not for a cycle. Now, many will have the high-class problem seeing the price appreciation go up. So, hey, I'll take some money out to buy a house now because I'll take some out. I'll spend in fiat. I'll convert some of that gold to US dollars and buy a house in the San Juan Islands. That's fine. but they're still saving. They're still saving in physical gold, and they're still buying more when they have excess capital. That's what our clients are doing. They're not asking about price. I very rarely in the many years have I had to argue with a client about the price of gold. Sometimes they feel like they're paying too high, the gold price is too high. And yes, the gold price can go down, it can retrace, but its direction secularly is really only in the first or second chapters now, because we are hitting that inflection point where central banks, even the bank of all banks, the BIS and the IMF, are realizing that gold is playing a central role in the next 15 to 20 years. And the coverage is going to change. We can argue about currency valuation, gold revaluation, whether China is going to suddenly announce a gold standard yuan. All that's academic and fun and kind of, I think, headline grabbing. But we do know this, we've known it for decades. Paper money loses value day by day in all currencies. And it's happening in real time. It's hard to see because it's a slow frog boil. If you're worried about whether you're outperforming private equity this year or Bitcoin this year or NVIDIA this year, that's a different mentality. That's a speculation mentality. Totally fine. But if you're thinking down the road to ensure fiat, dying fiat money, and you're thinking about something to give to your legacy, and you're allocating to have an insurance allocation to dying paper money, gold makes perfect sense. And the fact that family offices, the smart guys, are only in a 1% allocation. That's changing, by the way, rapidly this year. It's changing quickly. But they're finally catching on because they haven't seen the larger picture. They still think in an annualized return, beat inflation hurdles, get a certain annualized return, and diversify, I call it diversify, and highly correlated overvalued stocks and bonds. It's very hard to change mentality. Just like it's hard to go from globalism to neo-mercantilism, it's very hard to go from risk assets and stocks and bonds to some allocation to precious metals or some critical thinking about debt, treasury bonds, and currency debasement and central bank policy. And I realize that very smart people have no time to figure that out. And they don't have to just take my word for it. Get informed. You'll see this. It's not a gold case. We have so many investors who are portfolio managers of risk assets who still buy gold. Doesn't mean you can't speculate. It doesn't mean you can't have an opinion, bull or bear, on the dollar or on risk assets or on tech or on hard assets. But it's very clear where paper money is going, and it's very clear where it's been going since 1971. And it's only just starting. When based against the broad money supply, gold is still cheap. But not if you're looking to just get in out of it. Go get an ETF and trade it if you want to do it that way. I've rarely seen people do it well, very long or short. Most people get it wrong. But if you're thinking 10, 15, 20 years generationally, it's an obvious allocation. It's not the only thing. It's an obvious allocation. And again, central banks get this, the BIS gets this, our clients get this, hedge fund managers get this, bankers get this, some of them. Egon and I get this. It's what we believe. It's a bias, absolutely a bias, but it's also a very, very strong conviction. And it's the conviction of Ronnie Sturfula, Grant Williams, myself, many other people who are in the gold space, but we're also coming from risk asset banking backgrounds. So we see how the sausage is made. We understand it, and we talk about this because we believe it. Could we be wrong? Yes. Do we think we're wrong? No. And we certainly have been confirmed by history so far, regardless of the gold price. Egon bought at 300. It didn't go in a straight line. Never. He never once looked at the price. Still doesn't. I find that fascinating. As a mentor and a colleague, that helps me understand this far better.
Yeah. You need to think in ounces, not any particular fiat currency. All right. Well, look, Matt, I'm going to try to squeeze in one last question here before we have to wrap things up. Sadly, we're on a time constraint here. So you've made a great case for the reasons to buy gold, hold it for the long run, why it makes sense in this environment. Let me just ask you this, because we've been talking about currency debasement as a main reason to own precious metals here as a way to basically store value, right? Given that you think the system is headed towards some sort of currency calamity, what are the odds, do you think, about gold being remonetized at some point? Whether it's in fiat currencies eventually crater, and this could be 15 years, no one knows exactly when this will happen. Or perhaps it's along the way where you have competing new currencies, starting to emerge. I have no idea if it's actually going to happen, but of course, there's been rumors about the BRICS currencies. I think you've already alluded to it. BRICS countries coming out with their own gold-backed currency. There's been rumors that China might eventually back the yuan with gold, et cetera. What do you think the odds are of some future material remonetization of gold? And if you think there's decent chances, does that give gold an additional optionality on price where it might not just track, protect from inflation, but it might actually have some material appreciation because all of a sudden it's back to being money again?
Yeah, look, I said for years I never saw the U.S. dollar being gold backed. Even the BRICS aren't doing a gold backed BRICS currency; they're just doing gold coverage in their net settlements. So it is a trading currency, not as a redeemable currency that you can redeem in Shanghai or Moscow.
Right.
But they are using it to net settle trades. So in that regard, I see gold having a higher and higher role. The reason I say is no country, whether it's in the BRICS or the US, wants to take away its power to debase its currency. It's such a powerful and seductive thing to have. So why would you want to add a chaperone to your money? It's the cross of gold speech that William Jennings Bryan made way back. That it does limit your ability to extend credit, the gold-backed currency. So sound money, which academically and theoretically makes sense, is actually politically very unpopular. The leaders who every now and then during wars, and we've seen it throughout the US history, going on and off a gold-backed system since the Civil War, we like the power to debase our currency. So I don't necessarily say there's going to be a gold-backed yuan or gold-backed dollar anytime soon. What I do think was telegraphed in 2020 was the new Bretton Woods 2.0, this farcical video that you can still see on the IMF website. And Christina Georgina did this. It was literally called the new Bretton Woods. And they were using COVID as the excuse for a global reset due to the debt crisis that COVID created, excuse me.
Mm-hmm.
And again, I said in 2020, that was an absolute lie. It wasn't COVID, it was decades of banks like the IMF, the BIS, and the Fed debasing currencies. But they wanted to take no accountability, so they blamed it on COVID, nice and neat. Now we have a debt crisis. At some point, we're going to have to restructure debt, have a new Bretton Woods moment where it's a big kumbaya, and we'll have a new currency. And that's when they were going to roll out a central bank digital currency. Again, I'm not making this up. You can go to their website. It's right there. No accountability for their sins, but the solution they were presenting 5 years ago, which is what they always do, they telegraph it early and then they bring it out and say, I told you so, was some form of centralized or central bank digital currency. That's centralization at its finest. Liquid, central bank backed. But even in that highly centralized, programmable, trackable, evil thing, which is very safe and liquid, even in their chart on that video, they talked about gold as some type of coverage ratio because they knew a CBDC, which is electronic fiat, would not be credible without some coverage to a hard asset like gold. Otherwise, it's just electronic fiat versus paper fiat. And so the IMF was already telling us, I think then, where they want to go with this. Now, will it happen? How will that work with the BRICS? It's all kinds of unknowns. But you can see their thinking, just like you could see the BRICS thinking in Kazan last year. Gold is part of their equation at the IMF. Gold is part of the equation at the BIS as a tier one asset. Gold is clearly a part of the BRICS net settlement trade already and to come. The Shanghai exchange is becoming more and more popular and powerful than the London or New York exchange. China has a lot more gold in the World Gold Council. This is all my way of saying there is some type of digital centralized reset, not a gold-backed dollar or yuan, but probably some type of central bank digital currency with a gold coverage. That's my theory. I'm guessing, I'm speculating. I don't think you're going to see Trump or the next administration suddenly back the dollar in gold because we don't have as much gold as China. Then we'd be shooting ourselves in the foot. So it's a lot of unknowns. But I think if those with the money and those with the power make the rules, fiat money is just whatever the government tells you it is. What the IMF, which is very powerful and I'm not a fan, and the BIS, is they're kind of hinting that we're heading in that new direction, a / Plaza Accord, Bretton Woods 2.0, which I talked about with Brent Johnson years back. This was, I think, the direction they were going. And I still think that, but I don't think Trump's going to announce a gold-backed dollar or Xi anytime soon. They don't want to limit their power to debase. But if we get so bad in our global debt in the trillions, necessity is the mother of invention. They will blame it on extraneous events, never themselves, and then they'll impose on us centralized digital currency. And to me, that is the ultimate arc Adam, it's debt crisis, market crisis, currency crisis, inflation crisis, social unrest, always, without exception, followed by centralization. And to me, central bank digital currency is the final insult, and the final solution. And ironically, will have a gold coverage ratio to it. And that's where I see it going, not a gold backed dollar.
All right, fascinating. Matt, so many questions we didn't get a chance to get to. We're just going to have you back on again a lot sooner this next time. But really appreciate the time, the knowledge. Uh, Sorry to have to cut it off here abruptly. It's just the way that things work today. But anyways, Matt, so appreciative. Folks, if you are interested in learning more about Matt and his services there at his company, it is VonGreyerz.gold. Matt, I find that VonGreyerz is kind of a name that people oftentimes have trouble remembering when they type it out. So I'm putting up a redirect. Folks, if you want to go check out the site, just go to thoughtfulmoney.com/VG, and that'll take you straight to the VonGreyerz.gold website. Thanks so much, Matt. Really look forward to seeing you again soon.
No pleasure. Looking forward to it.
All right, well, now's the time in the program we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual this week by lead partners John Lodra and Mike Preston. Gentlemen, thanks so much for joining us. John, why don't we start with you? So, that was sort of classic Matt Piepenburg there. Always bringing it down to the big elephant in the room, right? Which is the sovereign debt chasm, mountain, whichever analogy you want to use, and how we have passed the event horizon. There's no way out at this point in time, other than through some sort of, in Matt's point of view, massive debt default / currency collapse. So obviously that brings into precious metals, which I know is something that you guys at New Harbor have a particular appreciation for, and we'll talk a little bit about what's happening in that space because there's some interesting things going on, especially with silver. But curious what your key takeaways for anything. Did Matt say anything that particularly resonated with you?
Yeah, hey, great to be with you here, Adam. And we always very much enjoy Matt's perspective. It is big picture and very laser focused on some really intractable issues that it's weird. We talk about it all the time. The politicians recognize it, but yet the can keeps getting kicked. It reminds me, I've had the opportunity in the last couple of years to be invited to speak at a senior college level finance and management class. A client of ours is a professor. And one of the charts I always bring into my talk to those students who are just about to enter the workforce or hope to anyways, I bring up a chart of the federal debt, and I bring up the chart of the purchasing power in the US dollar, and the eyes of these kids just glaze over. Like, how could that be? It's like so obvious to look at it in these charts and know that this is not sustainable, yet it's just they're incredulous in looking at these charts.
Right. And I guess you didn't mean glaze over like boredom. They were like,
no, like yeah,
eyes popping out of their
maybe
head.
pop
Oh my
out
God.
more than glaze over. Yeah.
Yeah.
I mean, it's just so utterly simple to the human mind that it's just absurd that we haven't really addressed this. And I know the Trump administration has done a lot of talking about we need to get this deficit thing under control, even if it means taking some bad medicine. That was a few months ago. Now, by all measures, and I think both people from all political stripes will agree in this. It seems like we've kind of fallen very short on making any kind of meaningful headway there. Government spending doesn't seem to be seeing any kind of notable reductions or plans for reductions. The spending bill, the one big beautiful bill, doesn't seem to have any real improvement in the picture. And as Matt has pointed out, this is not something that's going to be solved overnight. And I just like to share a chart here because I kind of recently we saw Fitch came in. Moody's came and lowered the U.S. Credit rating, and I thought that this would be a helpful reminder. Way back in 2011, S&P lowered the U.S.'s credit rating, and then Fitch, the second and the third major agency, did this in April. August of 23. So this latest Moody's one was just kind of like headline fodder. It really didn't say anything new. These are things that we've known about for a long time. And what I have here on this chart is a chart showing the federal debt as a percent of gross GDP. So this is the blue line is measured here. We've gone soundly over 100% debt to GDP. That's a major issue. And then if you look at federal debt here, it's over 36 trillion, I think now. These are intractable problems that didn't happen overnight, and they're not going to be solved overnight. This all ties into the US dollar, and of course it ties into precious metals, which we have long been proponents of in a proper dosage in a portfolio, even though most mainstream investors, and Matt talked about it, even the so-called savvy family offices have been rather uninvested in precious metals, even though it's been one of the most important places to be from a total return, but also in a risk-off scenario when we see these episodes of risk-off. The gold has outpaced even the S&P 500 since the tech bubble peak way back in 2000. These are persistent and we think long-standing trends that will likely be very important to pay attention to for many years to come.
All right, and I'm glad you put that chart up. One thing I want to underscore is, I think Matt's logic is sound, in fact, probably very sound. But you and I, John, we've known each other for over 15 years now. We've been concerned about these same, meta trends as Matt, right? And it's one of those scenarios where, I mentioned the Hemingway quote, you go broke slowly and then all at once, right? Where it does build up speed, but that slowly part can take way longer than you imagine, right? And I'm sure, like me, you've seen many people over the past 15 years who have seen that data, panicked about it, kind of positioned for the end game that seems like it's inevitable. But then they kind of get destroyed in the interim period as the status quo continues to continue along longer than many folks can imagine. And that's why I asked Matt that question is like, could we potentially through Doge, through growth, through a lot of the things that the Trump administration in particular is pursuing right now, could we extend that runway a little bit more? And Matt wasn't super sanguine on that, but I think I'm just mentioning this because I know how emotionally triggering it can be for people to see that stuff, and you very quickly go to like, oh my gosh, this thing's going off the rails, and Matt just really convinced me of that. I think the end might be actually exactly as Matt predicts, but the timeline could be longer than most folks imagine, and that's just one thing I just sort of want to underscore for folks, which is, we always say don't make decisions based on emotion. If you're finding yourself really freaked out by that data, don't necessarily then just say, well, then I got to sell everything that I own today and I got to put it in bunkers and cans of beans and stuff like that. That said, you talked about how those students, they could clearly see there was a problem with the exponential growth in the debt. Humans we don't think exponentially. And I think that's one of the big problems we get into in here. And I think I talked about this with Matt, where we really can't conceive of what a trillion is. We can kind of know how many numbers it is on a piece of paper, but our brains really can't appreciate how big it is. So you have these politicians who are making decisions around, okay, we want to issue another stimulus program, we want to borrow another trillion, or we want the Fed to monetize $1 trillion in our debt, and they don't really realize exactly how massive the implications of that are going to be down the road. And just as you talk to those students, John, I think I've let folks in this channel know, I sat down with my niece who just graduated high school and wanted me to teach her about money. And so obviously one of the things that was a huge part of that discussion was compound interest, right? And that was probably one of the biggest eye-openers for her. I'd created a spreadsheet and basically showed her, given the magic of compound interest and how young she is, that we could make her a millionaire by the time she's 50 without her having really to do a lot of heavy lifting, right? You don't really have to start with that much nor contribute that much to become a millionaire by the time you're 50. Now, you have to do it consistently. You have to really be dedicated to it, and you have to get the average return that the model assumes. But, if you're young enough and dedicated enough, it's definitely doable. So that was really inspiring to her. But then I flipped the script and we got to start talking about debt. And I was basically telling her in large part to avoid debt, especially non-productive debt. And when I showed her how compound interest works against you, where it's like, essentially like trying to escape a black hole. If the debt starts starts growing at a rate that's your income can't match. Again, another thing where I just didn't think she realized how overwhelming that could be. So the point here is you know, we're dealing with these exponential forces that humans are really just poorly suited to understand. And they've gotten to these levels of magnitude where they very well may be, we've passed the event horizon, like I said earlier. The gravitational pull of the debt that's out there just may not be escapable at this time, probably isn't. So obviously we need to ask ourselves, what are the implications going to be of that? And we as investors need to invest in the right things. We just have to be eyes wide open about it, which is it's probably not all going to end tomorrow. And so you don't necessarily want to get yourself fully into an Armageddon trade too early. So
Yeah.
sorry for the lengthy sermon, but I thought that was important.
On the whole topic of growing out of debt, we've been talking about this since the 80s. And the chart I just showed the massive expansion of the debt. And actually, if you look at the structural growth rate over the decades from the 80s up through the present, the rate of growth has actually steadily declined.
Decline, yeah. This is the Lacey Hunt. The more debt you have, it becomes a negative multiplier.
Absolutely.
Yeah.
So it sounds great, the idea of growing out of our debt, but that is classic political thinking. And, these are real issues that can be a challenge. And, another blatant example of this, every year the Social Security Administration puts out an audit report, for lack of a better word, that projects the sufficiency of the trust fund. And I think the latest one says, unless we make changes here, we're not going to be able to pay all the benefits promised, I think 2023 or 2024. We're talking less than 10 years now. This is not like, for most people, 10 years, especially as they're approaching retirement. That's not a lot of time. So there's open and candid acknowledgement that there are issues that got to be tackled here, but we lack the political will to do it.
Absolutely. And humans being humans, we're more likely to always push a problem off into the future, if at all humanly possible, versus deal with it now. Highly unlikely, to your point, John, that's going to change going forward. So we've got some new data that's come out this week, and it's, there's a little bit of maybe kind of good news, bad news of it. So the CPI came out, and it's still, mild inflation, I guess I'll say, which is I think the latest one year over year is 2.8% inflation here, right? So it's not down at the Fed's 2% target yet. It's the bad news. The good news is it's not really rising that much. And of course, past couple of months, people have been very concerned that inflation was going to start picking back up again because of tariffs and whatnot. We really haven't seen that so much, and we got some additional data this morning that the PPI, Producer Price Index, grew at 0.1%, which was less than what was expected. And so there seems to be a sense here that given perhaps how high, near record high corporate profit margins are right now, that at least right now, it seems like corporations are absorbing the tariffs so far. Now, will that continue? Who knows? But the point is that there were a lot of people at the beginning of the year who really thought that for a whole bunch of reasons, inflation was going to pick back up and become a continued problem this year. Year's not over, we don't know. But there have been others who've been saying, look, the economy is slowing now. Economic growth is slowing. And eventually, that's going to bring inflation down, and that's going to bring interest rates down. And so far, at least, that script maybe seems to be getting more validated here as inflation continues to pick up from here. So, to a certain extent, it's like, hey, good news. Inflation might not be so much of a problem later this year. The flip side of that coin is, but that might be because the economy may actually be weaker as we go further into the end of this year. Any quick thoughts on that, John?
Yep. To your point, maybe you got to watch what you wish for, because that very well could be the reason. I don't know, the inflation numbers, I can't say I studied them too deeply here today, but I think there was some mixed messaging there. I think core CPI kind of stayed pretty sticky at, I think, 2.8 annualized. Oil, we've seen some pressure in oil recently. There's some new rumblings going on in the Middle East with Iran, and that could easily unlock some of that. I think there's still a hesitant Fed, with kind of the right or wrong with the impact of tariffs and where those end up. If you look at the market's perception of or markets odds of Fed rate cuts. They marginally increased the odds of a rate cut in for example, September, from current 4.25 to 4.5, down 25 basis points. So far, the short-term interest rate market hasn't read a whole lot into this inflation report. Longer-term yields have fallen off pretty good. They were just a couple days ago 4.5%, the 10-year Treasury yield. We're now at 4.36 and change. So the short-term reading and the long-term yields is certainly maybe indicating some relief about inflation or trade tensions starting to wane. But these data series, 1 month readings are very tricky. You can't draw too much out of 1 month. It's the trend. And to your point, there are some positive elements of the trend, but there's also some sticky stuff. So we'll just have to wait and see, I think,
Yeah,
and
well,
see.
it's going to be interesting. You mentioned the Fed. There's, I think, an increasing sentiment going against the Fed that the Fed is too late here. Certainly, the president, has coined the term "too late, pal," and has been beating Powell over the head with that. But as inflation, the longer inflation doesn't pick back up, I think it gets harder for the Fed to continue to sit on the sidelines. But also today, we saw the latest continuing claims data, and that's starting to show a notable pickup. We're not at crisis levels at this point by any stretch, but it's the highest we've seen in a number of years at this point, and the momentum seems to be building to the upside. There have been recent interviews I've done on this channel, like the one with Joanne Shu from University of Michigan Consumer Sentiment, showing that consumers are really nervous, both for their jobs, but their wages and the stock market in general. And she thinks that it's highly likely that they're in the process of changing their behavior, which could then reduce consumer spending and bring corporate profit downs even more, and then that could then lead to even more layoff, or it could lead to a layoff wave. So who knows what will happen from here, but as we've shown many, many times in the past, it's once the unemployment rate starts to move, it tends to move really quickly. And these continuing claims are a potential leading indicator of where the unemployment rate may be heading going from here. So we'll just have to watch it really closely. All right, Mike, I'm coming to you here. So feel free to add anything to the Piepenburg discussion you'd like to, but one of the big things, obviously, that Matt, comes to when he looks at the debt problem is to say own hard assets, and he's a big fan of precious metals for all the reasons that he just mentioned. Precious metals continuing to do well. And the day we're talking here, gold back above $3,400 an ounce. But I think the real story over the past week has been silver. You have been saying forever that silver had built this long-term, decade-plus long cup and handle, and you were waiting for it to break out of the handle. I think we have an official breakout now, right? With silver cracking above 35 bucks an ounce. And I think today that we're talking, at least in the futures market, it's 36 and change.
Yes, thanks, Adam. We've been talking about silver for the longest time here. It was frustratingly slow in following gold's lead, frustratingly slow in breaking out of that consolidation that you just talked about. But breakout, it finally has. Trading at around 36 right now. We've talked about a potential triple top at 35 for many, many months. Gold broke out of a consolidation a few years ago at around 2000 and has since moved up to 33, or actually as of right now, 33.86. And if I could ask my partner John to pull up a chart, I'd like to just point out a couple things on the gold and silver chart. So this chart is gold and silver over a bunch of years. Looks like close to 20 years here. Gold is in the purple thin line, and silver is in the other, kind of candlestick red and green line. So silver tends to be much more volatile and fast moving than gold. Take a look at back in 2011. Silver essentially went like a rocket straight up to about $50 an ounce, and then crashed close to, it looks like 80%, I guess it was, 70, 80%. It was a long bear market for both gold and silver. Gold came down 40%. Silver, like I just said, came down 80 or so percent during that time. But look at gold. It took off about 2.5 years ago, right around where that arrow is. Just kind of shot out of that consolidation, that big long cup and handle that you mentioned. Went from 2000 straight up to, at the moment, almost 3,400. Silver has been building what I would call a flat base or a triangle here over the last year or two, and is now finally broken out of a triple top. We're looking at a monthly chart here, so it's hard to see, but you can see this is a big month breakout here right now, and it basically overtakes or supersedes the previous three highs at around $35 an ounce. So it's a big moment for silver. We actually track these things very closely. We take a look at the strength in all of the markets, and frankly, all of the markets, not just the gold and silver markets. But we're noticing here that silver is starting to overtake gold in terms of relative strength. It had this big breakout at 35 that we think is important. And so we added a 2.5% position to silver. We already have a 10% position in miners. We like miners at the moment a little bit more than gold bullion because its relative strength is stronger. We're always looking at what's moving faster versus other assets. And in the space of gold and monetary assets, miners are doing better than bullion at the moment. But when you look just at metals themselves, silver is all of a sudden doing better than gold. And we expect silver could move pretty quickly up to the 38 to 40 area here, and then over the next few months into the low 40s. And so gold doesn't necessarily have to keep moving up for that to happen, although we're very constructive on gold as well. So it's nice to have a tailwind here. It's been a long wait for silver bulls, and don't be too quick to think that it's that the trade is getting too crowded or that there's too much optimism. There certainly is more optimism in this space than there has been for a long time. If you take a look at the leaders and momentum names, on that list is a lot of mining stocks, but be careful about calling a top there. This thing can go for a while. The best thing you can do is hedge a little bit, reduce your exposure if you feel like you've got too much, rebalance. And that's what we're doing at certain times. So we completely agree with Matt Piepenburg here in terms of long-term gold bull, and we're happy to see it finally mattering. And if I'll pause here for a moment, Adam, but I've got just a couple things to say on Matt's talk too, if now's the appropriate time.
All right. Well, let me just ask one or two things about precious metals, and then we'll wrap on your closing Matt's comments. So, you guys have heard me talk about that analogy of the precious metals complex like the whip, right? The gold handle moves first, but moves least, then the miners, then the silver is kind of the tip of the whip here, right? So it seems to be playing out now the way that we would expect, right? Gold moved first. Now the mining complex is moving earnestly. And then silver, the tip of the whip, is starting to make its move here. But it seems like you think all three components of the whip still have more room to move. In other words, I believe you think gold still has further to go here. That means the miners will still have a fair amount of catch up to play. And then silver will really, make a fast move or make a dramatic move here. You talked about silver getting up to high 30s, 40s, whatnot. Mike, when you think back to the slide you showed a minute ago, where we can see where gold has already moved, and we can see that silver is now starting to break out. How far do you think silver would need to move to match where gold has already, given how far gold has already moved? If silver were to have its commensurate response to that, where in general do you think it would end up?
It would certainly be a new high, Adam. I don't think we need to predict that at this time. What John just brought up here is the gold to silver price ratio.
And sorry to interrupt, but when you say new high, you mean above $49 an ounce? I think that's the previous high for silver.
Yeah, for basically $50 an ounce. You're right, 49. Let's call it 50 just to round off. I do believe that silver will get to a new high. To answer your question directly, the commensurate price would be 60-ish, I think, just kind of eyeballing the charts. And so we don't have to have that happen, but I think that's likely to happen. I think silver will go even higher over time. All of these concepts that were talked about during this video today are true, and it's impossible to time them. And we've been talking about them for, like you said, 15 plus years. But this isn't going away soon, and I wouldn't try to call a top on these things because, well, I've learned a long time ago in my career that calling a top is very difficult. And I'm not saying go all in or just, willy-nilly be crazy risky here, over concentrated. But I think calling a top here is extremely early, probably wrong thing to do. And silver should likely go ultimately to new highs above 50 and then much higher. But I would expect that to take a year or more. The numbers that I told you earlier, 38 to 40, I would expect who knows exactly, but based on the charts, that could be in a month, and then
Yeah.
low 40s in a few months.
Okay. And one of the reasons I'm asking this is, for years we have told people how the precious metals complex is likely to move when the next bull market in it arrives. And it tends to happen pretty fast. And so we've said in a lot of cases you want to be in it or have a position in it before that move starts, because once it starts to move, if you don't react quickly, you may miss it, right? And I think there are already questions emerging of people saying, gosh, I wish I'd been in this. I wish I'd listened to you guys. Is it too late to be in here? And what I hear you saying, Mike, is likely not, that there's likely still some pretty good movement ahead of us here on all three components, but particularly on the miners and silver. Correct that if that's an incorrect statement. But the one thing I'll add to that is um, if you do jump in, and especially if you're new to this space, just be aware it's a very volatile space. So Mike may very well be proven correct that silver may make an all-time high, a new all-time high in the next year or so, but it's highly likely not going to be just a straight ride up. So I'm just saying that you could be jumping in now here at 36 and then ride it down to 28 and then, have to wait for it to come back up. It's that type of a volatile asset. So just be careful of the ride you may be taking here.
Yeah, you got to be able to survive the ride, Adam, both financially and psychologically. And sometimes psychologically is more important. So don't expose yourself to more stress than you really need to. And that means just don't take too big of a bite, dollar cost average in, things like that. For people that aren't in it at all, I think silver provides an even better opportunity right now. The chart that John flashed up just a few minutes ago was the gold to silver ratio. And right now we're at around 93 to 1, 93 ounces of silver it takes to buy 1 ounce of gold. We touched 102 or so a couple weeks ago. And the only time higher than that in the last 20 something years was back there at the COVID time where we hit 123. So this chart, it doesn't, again, like all these charts, it doesn't really tell you much about timing, but it tells you that silver relatively is a better value probably than gold. And if you couple that with the triple top breakout in silver above that important 35 level, silver is likely a better deal. Now, if you're putting lots of dollars in to gold and silver, you're probably going to have to buy more gold just because of space issues. But I talk to a lot of people, both in the course of the business that we do or just your friends and family that are just now getting interested because, well, there's some news items out there about gold and silver now. Now, normally that would be a warning sign, but I would not take that too seriously. I think that I do think the trend is going to be higher for longer here. But I would tell people to start with silver if it's for smaller dollars, just because I think they can withstand the path better in the volatility that silver produces because it's relatively small dollars, and B, because I think there's more upside in silver.
All right. Last question on this, then we'll start wrapping up. Crossing our fingers, hopefully we get the full bull market that we expect. What will you be looking at to make the decision to say, all right, you know what, this has run its course and it's time to, start taking gains and maybe shifting capital into the next undervalued asset class?
Wow, so there's a lot to that question. Basically, how are we going to know that it's time to pull back the reins? How do we know that it's a market top? I got to tell you that everything has been in place from a macro sense for more than 10 years just to tell us that a market top should be here. But policy has been so completely off the map that we've all been forced to kind of rethink the rules and just play a little bit of game theory. Like Matt talked about in his talk, he said that monetary policy is not really policy. He said it's a charade. And I think he said it's a charade and a scam. I believe is what he said. And I love that he said that because that's essentially what it's been. And a lot of the market that we see here isn't real. It's somewhat of a scam. And particularly if we see the kind of pullback that we think that we're going to have, 60+%. Now, I don't know if that's ever going to happen. Matt said that, hey, maybe policymakers can keep us from ever having a S&P correction of more than 30%, but that's not going to happen without destroying the currency. So everyone in the modern times, the last 15 years, has had to play the game and just surrender to it to one extent or another. We have a relatively lower risk exposure, and so therefore we have underperformed in vertical markets, but we certainly overperform in down markets, and our hedges keep us in the market, so to speak. So we have about 45% market exposure here. It's because of our hedges and the options that we have in place that we feel like we can do that. So I don't know what's going to cause a top here or when that's going to be, Adam. It could literally be here. We're starting to believe we're going to get some kind of vertical blow off top, though. And if we do, if we get a vertical blow off top and you start to see the S&P go up 500 points in a month or something like that, I think we're going to be pretty close to the end. So I don't know if we're going to get lucky enough for it to be that obvious. The whole world seems to be watching for that, but it's feeling like that might indeed happen. And so if that happens, we will likely reduce exposure into that ramp. If the alternate happens and we start dropping down and breaking through some support levels, we'll take stops and start raising cash. So we don't have to know. But, you know, between you and me and the viewers, I hope that we get this vertical move higher, which will make it easier to pinpoint near a top.
All right. Okay. Well, look, as we wrap up here, Mike, you said you had a few other points about Matt's presentation.
Yeah, the big one was the fact that he said the policy wasn't really policy, you know.
Oh, okay.
And I think that's right.
So you've already weaved that in. Okay.
Yeah, and one or two other things. Yeah, he basically said we're in a revolutionary moment. You know, debt was 30 trillion in 97, and now it's 300 trillion. I mean, it's just all of these things were eye-popping and things that we already know. But I think that, and then lastly, he talked about the fact that gold is now a tier one asset. So the whole world seems to be waking up here. I just feel like Matt has talked about all the things that we've talked about for many years on this channel. Yet people that are in our business that are really young have never even seen a great financial crisis, never, you know, never mind a tech crash. They haven't seen any lasting down markets. And so I think that it's important to have an active strategy that has stops in mind and you know, hedging tactics in mind, because I think that everything's going to change in the next few years. I think that we're in a climactic phase.
Okay. Well, Matt would certainly agree with you. And, you know, it's interesting, like you said, we've been talking for a long time about this precious metals bull market we're hoping will arrive. And it's been, I got to say, it's finally been fun to be an investor in this space after years of feeling like sometimes you're waiting out in the wilderness. And, you know, looking at my portfolio now with the mining stocks in it, there are a lot of stocks now there that have up 50%, 100%, 200%. I've got one or two that's above 1,000%. Those are really fun. And that's, you know, sort of what we were hoping for here. Now, full disclosure, the portfolio has had a lot of stocks culled from it over time that were down 50%, 80%, whatever. So there were a lot of, I don't want to pretend here that I've been some phenomenally brilliant investor here. I've certainly taken my licks along the way. But it is nice to see it start to play out the way that we thought it would. And just one parting thing I want to note for folks is the small, I mean, the tiny size of the precious metals sector, especially mining stocks and silver. They are just tiny relative. They're small relative to the gold market, and the gold market's small relative to, you know, the stocks and the bond market. And the reason why that's important, we talked a little bit about this with Matt, is what's been driving the gold price so far has been central banks buying it in greater quantity over recent years, and the Eastern speculator, the Eastern investor, has been buying them. The Western investor really hasn't that much. And there's a lot of reasons why the West has kind of down on gold. You know, as Matt says, it's kind of the mirror that reveals the currency debasement of the policies of those that are in power and all that type of stuff. But at the end of the day, Wall Street loves profits more than anything. And when it finally begins to wake up to say, look, this sector has got momentum that I want to be in on, it's not going to take that much money coming into this sector to, again, cause it to double, triple, et cetera from here. Will that happen in this bull market run? Who knows? We're going to find out. But the potential for it is there. And that's just one important thing to keep in mind. All right, so in wrapping up here, gentlemen, it's been a great week. Folks, if you enjoyed having Matt return to the program, would like to see him come back on a little bit sooner, let us know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Obviously, if you'd like some help with your portfolio in positioning, for a lot of the macro things that Matt talked about, but some of the more near-term items and opportunities and issues that I've talked about here with Mike and John, highly recommend that most people watching this program, get advice on how to do that, customized advice on how to do that from a good professional financial advisor who can craft a good strategy for you and then execute it for you. If you've got a good one who's already doing that, great, stick with them. But if you don't, or even if you just like a second opinion from one who meets those criteria, or perhaps even John and Mike and their team there at New Harbor Financial, then consider scheduling a free consultation with one of the financial advisory firms that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill it out. These consultations are totally free. You'll get bespoke, personalized guidance from these guys, and there's absolutely no obligations to work with them. It's just a service they offer to be as helpful as they can. John and Mike, guys, another great week. Great job today. And it's going to be really interesting to see what happens from here. There's a bunch of other stuff we didn't have a chance to talk about, a lot of trade updates, China-US trade, a lot of other stuff going on in the world. We'll pick that up next week. But thanks again, boys.
Thank you, Adam. Happy early Father's Day to you and your viewers. And thanks for having us again.
Yeah, thank you, Adam. Great talk. So happy to be here, and we'll have more to talk about next week. Thanks.
All right, thanks. And happy Father's Day to you and all the fathers watching today. This video will be launched in the morning of Father's Day, so I hope everybody's having a wonderful time. And with that said, everybody, thanks so much for watching.